It's the Lloyd for Real Estate podcast.
I'd like to welcome everyone to Lloyd for Real Estate podcast. This is Lloyd Bowman, eXp Realty. So glad you could join us today. And joining us today is, before we introduce them, before we bring them on, we have been looking at the market today. Things have been changing, and we've been seeing a drop in interest rates. And as by chance, a lot of you potential home buyers have been getting kind of curious, kind of been thinking things over a bit and saying, hey, Lloyd, look, interest rates have been dropping. I kind of got my ducks in a row. Credit scores, all right, I think I'm okay. The family is expanding, getting a little bigger, need a bigger place. So I've been thinking about buying a home. And to be honest, I don't really know where to start at. So what are some of the things that I could do as a potential home buyer to get my feet wet in the real estate industry? I never bought a home before. Most expensive thing I ever bought was an automobile. And so I would like to get my feet wet, kind of firm and planted on the ground in terms of purchasing a home at some point in the next 3 months, 6 months, maybe even the next year or so. And we've been looking at things in the Chicago market. Like the median home price in Chicago is around $350,000. And so we've been seeing the dynamics change. We've gotten our reports from National Association of Realtors. And one amazing point that I saw, that this was kind of fascinating to me, is that today the first-time home buyer, the age has pushed all the way up to 40 years old. Imagine that. Imagine that. So my guest today, we're talking with someone that has about 30 years of experience in the mortgage industry. He's the regional vice president of the Kimball team here in Chicago for Cross Country Mortgage. I'm going to bring on my esteemed colleague and friend, Richard Kimball. How's it going, Richard?
Good, Lloyd. It's going really well. Thank you very much for the warm introduction. And that 40-year number that you gave me, that I saw, the National Association of Realtors came out with that, and just floored. I was just floored. And another statistic that they came out with was the percentage of first-time home buyers in the market was down to 21%, and that's one of the lowest percentages we've had it's a record. Like, normally first-time home buyers have a more dominant share of the marketplace, and that's just not the case. We talk about affordability and the entry level. Yeah, the entry level is definitely a little bit higher. But at the end of the day, where to start is with the money. We're not going to be able to do this without the money. And we always talk about the fact, Lloyd, that where you start, like if you're thinking about buying in the spring, now's the best time to talk to your lender. And it's the best time, because if there's anything you need to sort out, we got 6 months to sort it out. If you're perfect, that's awesome. But what if you're not? What if you can make a little change that could make the difference of whether or not you qualify for $10,000 in grant money or not? And so the sooner the better, ultimately.
That's a pretty interesting point there, Richard. So I guess buyers do have questions. They have things on their mind and wondering just how to tackle this beast, how to kind of actually get started. And I think some of the questions that I come across as an agent is, for one, how to approach a lender, how to find one. Sure. That's where I come in as an agent. We can assist with that and introducing you to people like Richard Kimball here. But we get these kind of questions, and a lot of them, they want to know, just starting out, what is a mortgage? What is a mortgage loan? What kind of programs do a mortgage lender offer? And which one is the best one for my financial situation?
Sure. Yeah. Well, we'll tackle the first one, the mortgage loan. Lender is making a loan to you, giving you the money to buy the house. and then we record a mortgage against that deed. And that's our security instrument, and you'll pay that thing off eventually, but it gets you into the home. The home's titled to you, just has a lien on it by your mortgage lender as far as that's concerned. Now, the third part of your question was where do you start with a lender? I think it was.
Yeah, where do we start with a lender, and how do I address my financial situation
Yep.
compared to that?
Yep, I got it. So you'd mentioned in the first question about, the different products and things like that. So first of all, you got to go find a lender, ideally one that's referred by a real estate agent. Most real estate agents have great lending partners. They really rely on the lending partners to make sure their process is smooth and everything goes well with you. So the first place to start, always go to your real estate agent first. If not, family or friends may be able to refer you somebody that's reliable. You ultimately want a lender that's doing loans on a regular business. It's not a
Sure.
part-time gig for them. Just like real estate agents, I warn against the part-time realtors. You want somebody that's full-time in the lending and full-time in the real estate. Now, you go meet with that loan officer, and really, as far as assessing your financial information, you're going to have to provide what we call a client questionnaire. And it gives us an idea what your income is, what your assets are, and then what your credit is. We're going to eventually need to get into credit. And through the analysis of that and a couple questions about your long-term intentions for this property, the lender can determine what the best program is. We could literally talk until Thanksgiving about the numbers of types of different programs that are out there. It's really a matter of the lender getting your information as a home buyer and determining what program makes the most sense for you in your scenario, based on your income, based on your assets, and based on your credit. One quick thing to know, since the housing bubble, lenders, for the most part, are all paid on the same. It doesn't matter if we give you an FHA loan, a conventional loan, an adjustable rate loan. We get paid the same. We get paid based on the loan amount you borrow. So the incentive really for the lender should be to put you, the borrower, in the best program that gets you into the home as comfortably as you can.
Absolutely.
Yep.
So I mentioned starting out here, interest rates, and we've been seeing this in the news, like things are starting to come down. We're not getting back to where it was during the pandemic, but things have dropped, have gotten a little better just in terms of being in the favor for the buyer. What is the current interest rate situation, and what is the difference between a fixed and an adjustable rate mortgage?
Perfect. Rates now are in the sixes pretty comfortably, depending on the program, of course. When we talk about sixes, we're talking about people who are going to live in the property. Investment properties tend to be a little bit higher, but being in the sixes and comfortably in the sixes, depending on the loan product, really has not been a place that we were in 2024, 2023, even 2022. Those rates were in the sevens in those 3 years. So we've come down to the sixes. We're not going to ever see, I shouldn't say ever, I believe in our lifetime, Lloyd, we're not going to see 2% interest rates, right?
Yeah, that would be nice.
And that would be great. But, I always tell folks, like, look, if you're waiting for that 2 or 3% rate to come back, you're waiting for the next 100-year pandemic, because
Sure.
that's essentially what it took to drive those interest rates down to those very low numbers. At a 6% level, the rates are pretty good, whether it's low sixes for an FHA, mid sixes for a conventional loan right now. Those are great interest rates today. Very, very affordable. As far as an adjustable rate mortgage versus a fixed rate mortgage, for a long time, the adjustables just were not that attractive. We had something technically out there called an inverted yield curve. What an inverted yield curve is when the longer term interest rates are actually cheaper than the short-term interest rates. That's an inverted yield curve. They always talked about it as a recession predictor. Like, hey, when you can go out, I don't know if you remember this, Lloyd, but like 2 years ago, you'd be able to go out and get like a 12-month CD and get paid by a bank 5.5%.
Oh
Edward
yeah.
Jones, I think, was paying like 5.5, six
Oh
percent
yeah.
on
Yep.
a 12-month CD. The 10-year treasury was in the fours, meaning that if you took that same amount of money and invested it for a 10-year commitment, you're only going to get four. You
4%.
could run off to the bank and invest it for a year and get 5.5. So that also meant that adjustable rate mortgages were not super attractive. Now, things have changed a little bit. We've gotten out of that inverted yield curve a little bit. So adjustable rate mortgages will come back and be a little bit more favorable. Typically, when we're not in that scenario, then you'll see an adjustable rate. So for maybe 3 years, 5 years, 7 years, they even have a 10-year adjustable, those rates will be a little bit cheaper than the fixed. But certainly over the last couple of years, the fixed rates have been competing with the adjustables pretty well.
Okay. So now I'm interested home buyer, and it's sounding good. It's making sense. Okay, 6%. So if I were to go into one now, let's say I'm ready to buy it today and got everything lined up, how would that interest rate affect my upcoming payment?
If you're gonna buy in the 6% range, you mean 6.5, how it's gonna
But
affect?
say I'm gonna do a 30-year at
Mhm.
6%, and the house I'm looking at is $350,000. How would that affect my payment? Is it determined by the amount of money that I put down? Is it leaning more toward my credit score? Is it based on how much debt that I'm carrying?
Oh, okay. Yeah, those are all great questions. So if ideally, your down payment does have an impact on the programs that you'll have available to you. The more money down, the more likely you'll probably go into a conventional type loan. The less money down, the more likely you might be in an FHA loan, as an example. The lower your credit score, the more likely you'll be in an FHA loan versus a conventional loan. So those definitely have a little bit of an impact. Certainly, the more money you put down, the less your payment's going to be. Interest rate will have a bearing. I'm sorry, credit score will have a bearing on your interest rate. Lower credit score, potentially a higher interest rate. Now, that does get a little bit complicated because Fannie Mae and Freddie Mac have come out, they have what they call loan level price adjustments. There was a big buzz a couple years back about people with higher credit scores paying more than people with lower credit scores. Do you remember that, Lloyd? It was like
Yes,
2 years
yes,
ago.
indeed, yes, indeed.
Yeah. And it wasn't really true at the end of the day. Like a lot of the things in the media, you got to go way past the headline and you got to get down to that like third, fourth, fifth paragraph.
Absolutely.
The people with the higher credit scores, yes, they were going to pay a little bit more than they paid yesterday, but people with lower credit scores were still paying more than them ultimately. So they took a little bit of that from the bottom and moved it to the top. But at the end of the day, the people at the top pay less than the people at the bottom relative to credit scores. So what they did do, which was great actually, is Fannie Mae came out and they said, look, under certain income limits, if we have a first-time home buyer, we're not going to charge any of that extra money. So we're going to give what's called a loan level price adjustment waiver. And that's a big, basically the
Yeah,
short version for that, Lloyd, is we're not going to charge you extra if you have a lower credit score. Period. We're charging you the same, whether it's 780 or 680, it's all going to be the same if you're a first-time home buyer under a certain income limit. That's why it's very hard for, I think, a lender just to blanketly say, hey, Lloyd, just talking to you right now, as short time as we've talked about, the perfect loan for you is a 30-year fixed conventional. I don't know
hear that
enough
a lot.
about you. I
Yeah,
don't know what income limits you have. I don't know where your credit score. I need to know all of that stuff to place you in the right program.
absolutely. So now we get into conventional and FHA.
Mhm.
First time home buyer. I've been hearing these terms. What does that actually mean, and how much do I need to bring to the table in terms of a down payment?
Perfect. FHA's minimum down is 3.5%. Fannie Mae, which is conventional, Fannie Mae, Freddie Mac, that falls under the conventional umbrella, that's going to be as little as 3% down for a first-time home buyer. So those are essentially so the down payments are actually pretty similar. Now we start talking about down payment assistance and grants and things of that nature. The state of Illinois and most states have a bond program, and that bond program here in Illinois is called the Illinois Housing Development Authority. And under that program, you can get anywhere from $6,000 to $10,000 in assistance for down payment, for closing costs. And it doesn't matter the loan program. You could do it conventional, FHA, even on a VA loan with the Illinois Housing Development Authority, or IDA, as we've acronymed it. So,
sounds good. So after deciding on an FHA or a conventional or a VA loan, what is exactly the underwriting process and how does that work? And what's the timeline and process for that?
yeah, perfect. We'll start with the VA loan primarily because there is a component there that no lender has control of, and that is the VA has its own appraisers. So with them having their own appraisers, all lenders are kind of tied into whatever that turnaround time looks like. So it's one of the few things we lenders don't have 100% control of from cradle to grave.
Okay.
So that process, now the VA appraisers have gotten much, much better and much, much more realistic in their turn times. So the turnaround time, at least as fast as we go, look, if I've got somebody who's clean, I could do a VA loan, probably get that done and closed in 14 days, in spite of the fact I don't control the appraisal component. FHA loan, 10 to 14 days. It can move quickly. And I usually tell clients, I said, look, I can move as fast as the wind as long as you're willing to participate. Yeah, the biggest hang up I have, Lloyd, in getting somebody's loan closed on time, unfortunately, is the home buyer. They're the ones I can control my end of it, but I can't control how quickly they turn over documentation. And, we really coach our realtors about letting the client know they can cause themselves all kinds of headaches and delays by not giving us the documentations we ask for within a timely manner. Now, look, lenders ask for a lot of documentation. Since the housing bubble, we're crossing every T and dotting every I. We have to do it. We in the lending community, whether it's me, a credit union, another independent mortgage banker, a bank itself, if we don't do that due diligence, we end up buying those loans back. And there's no lender that wants to do that. So we have to have the proper documentation, and it's dictated by the government. The government's just not going to let us fly out there and go, you get a loan, you get a loan, you get a loan. It doesn't work that way anymore, unfortunately.
Yes, indeed. So we started the underwriting process. I got a pre-approved. Things are going. I'm turning in my documents, and we're almost close to closing. I've been to Home Depot. I saw this refrigerator and this kitchen set that I want, and I'm going to go and put that on my card because that would look nice in my new home. Should I go ahead and do that?
No. So if you are properly coached by your lender, and sometimes the realtors get involved, and we can sometimes use all the help we can get, but if you're properly coached by your lender, yes, we're not going to be opening up any new debt. I mean, that's ultimately not opening up any new debt. And if you have to open up new debt, you need to call your lender and say, hey, look, I'm in a pickle. Now, you walking through Home Depot wanting that refrigerator for your new place, that ain't have to open up new debt. I'll give you a great example of having to open up new debt. I had a young lady who had a house under contract, and she got in a car accident, and it was pretty decent accident relative to her car. So Lloyd, she called me from the side of the road. Literally, I could hear people in the background. I could hear the cars going by, and she's calling me and she's bawling. And she said, Rich, I think I'm going to lose my home. I have to buy another car. And I'm like, oh my gosh, what's wrong? Are you okay? What happened? She goes, I just got in an accident. And she's bawling. I'm like, Did you call an authority? Did the police coming? Like literally,
Right.
this is how, like, this just happened. And the only thing she can think of is, I'm going to have to replace this car that didn't have a bill. And now I got to get a bill. Well, because of literally how conservative she was with her own stuff and how concerned she was, yeah, she could afford a $400 car payment. But she called me from the side of the road.
Wow. Wow. That's
the
diligent. Yeah.
uh, the other side of that is, so all lenders are required to check on credit right before we close. And we're not doing it because we're the big bad guys or we're meanies or anything like that. If I don't check your credit before I close that loan, I have a loan I might not be able to sell. And
Sure.
that's a problem. So I have to check a credit, and somebody goes out and gets $1,000 car payment and doesn't tell us, yes, they can torpedo their entire home buying process by going and adding a new car without talking to their lender first. So do not add any new debt. Yeah, definitely not a good
Got it.
idea.
Got it. So another one that I get a lot often, saved up a nice amount of money, things are going well. And I've picked out a house, been looking, I've been thinking, but I would like to move forward. What you're saying been making sense, but my credit score, last I checked, it was around 550.
Okay.
What can I do? I would like to get in a house at some point, but what could I do as a
Sure.
buyer with
Yeah.
bad credit?
As a buyer with that credit, so let's talk about 550 on the surface.
Mm-hmm.
FHA will lend to that credit score with at least 10% down. So if somebody has 10% down, that credit score is good as it is. Now, one thing your audience might be curious about, you might have heard about, is that conventional Fannie Mae has come out and said, hey, we used to have a low score of 620. We won't lend past 620. Anybody's lower than that, Fannie Mae, it was just hard stop, you're done. Fannie Mae came out recently and said, we're taking that out of we're not going to use 620. As far as we're concerned, we won't have a bottom score. So now, if you think about it, and certainly the way I've seen it out in the media and all that, your client with the 550 score might think, hey, I can get a conventional loan because they don't have a minimum credit score.
Right.
However, they're going to be looking for a stronger credit profile overall, meaning probably a bigger down payment, meaning that, long job time, maybe some extra money in the bank. So somebody with a 550 score coming in with 3 to 5% down conventionally, I don't see that we're going to see those approvals.
Mm-hmm.
And I just wanted to take that score on the surface for what it was. Now, most lenders will have something embedded in their credit report, which will tell them as soon as they review that credit report that they have the opportunity to increase this person's credit if they do certain things.
Okay.
The quickest way to add points to your score is paying down your credit balances. And one of the things that's probably about 30% of your credit score is how much credit you're carrying versus the limit you have. So if you have a $900 balance on a $1,000 credit card, you're 90% advanced. That's going to look really bad and potentially be worth 30 to 40 points because you're 90% advanced. And I want to stress something. It's not about the dollar amount, because you could owe $9,000 but have a $100,000 limit. Well, you're only 9% advanced. They're only looking at the percentage, not the dollar.
Okay.
So that's an important part. It's not how much money you owe, it's how close you are to that limit. And worse is to be over that limit. That's even more points deducted off your score. So for your client with the 550 score, quick fixes that I'll send to you and your audience is A, paying down credit cards at the consultation of your mortgage advisor. B, getting added as an authorized user to somebody's account who, by the way, has a good credit account. Don't get added as an authorized user to an account that's maxed out. That's not going to help you, right?
Yes,
That's horrible.
right.
So those are two really quick fixes that you can immediately add points on. And then third, you could talk to a credit professional about maybe working on getting some of the negative things removed. I don't really recommend people try to do it on their own because look, most of us have jobs. We have things we want to do during the day. Being on the phone with a collection agency for 2 hours trying to get something removed is not that just doesn't seem like a good use of time to me. So
Absolutely.
find a reputable person and have them help you take care of the negative stuffs on the credit if that's what's bringing the score down. So,
Okay. So I got this 550 credit score. I'm gonna put 10% down. What kind of rate will I end up, and will I have an expensive mortgage?
let's assume that you would get FHA approved with your 550 credit score with 10% down, and we've done those loans across country. We are one of the few lenders that will lend into these lower credit scores. We have a really good success rate, and just quickly, Lloyd, we're not making bad loans because that's not, we're going to get judged on those loans too.
Absolutely.
We have a report card with FHA, and if we fail, they're not going to let us do any FHA loan. So we are making what we consider good loans in those lower credit score areas. As far as the interest rate is concerned, if we would say the going rate today for an FHA loan is 6.25 with no points, great situation. Somebody with a 550 score, they may give us that interest rate, but they would want to add 2 points in just points.
Mhm.
Now, what I might do for that client, maybe they don't want to come up with the 2 points because they already got to come up with the 10%. I might tell that client, okay, we're going to take a 6.75 rate and we won't have those points. You'll still have a no point option. You're just going to pay a slightly higher interest rate, but you're going to get into the house. When your credit improves 7-8 months down the road, we can go ahead and refinance you.
Mm. Okay. And quickly, you had mentioned points. Could you explain to our audience what points are and how do they work?
Sure. Points, what you'll hear is specifically discount points are to discount the rate. Traditionally, what you would hear is that 1 point paid should equal about 0.25% in the rate. So the example that I gave you, we want to get rid of 2 points. Our rate's going to go up 0.5%. So typically points will buy down in interest rate and give you a better interest rate.
Okay. And let's say that we're in a situation where I found a home and me as the buyer, I'm responsible for paying the agent.
Oh, yeah.
Is there a way that I could work that into my mortgage payment, the down payment? Say I need to come up with another percentage point to cover what the seller is not willing to pay the agent. Is there a way that I could work that into my mortgage payment?
Yeah, for sure. There's a way to do that. The example that we just gave could kind of work in your behalf. Let's say you're in that situation, and let's say you're an FHA buyer with a 680 score, and you've found yourself in a situation where you're going to be having to pay the buyer's agent another percent. So we as a lender could end up giving you, instead of giving you a 6.25 rate, we give you a 6.5% rate. We take the premium that we're getting for charging a higher interest rate, we give it to you as a lender credit. You can use that to pay your real estate agent. So there's definitely a way to do it.
It's a way to do it. Okay. And say, okay, I finally got into the house. We closed, making payments, and we're good. Let's say 15 years in, I've been making payments. I didn't pay interest now. Now I'm tackling the principal. I end up playing the lottery. I won a big amount of money. I want to go ahead and pay off my mortgage. Will I get penalized for paying off my 30-year mortgage early?
No, not at all. Yep, not at all. Yep, definitely. Yeah. Yeah, prepayment penalties do exist, not on owner-occupied property. You will not see prepayment penalties on owner-occupied property. Where you'll see prepayment penalties is commercial property. So anything of 5 unit or more, mixed use, industrial, you guys could restaurant, car wash, or investment property like true investment property, we are seeing a little bit of the way of prepayment penalty on investment property. So typically the prepayment penalties on investment property usually expire after 3 years. So even in the situation you just gave, 15 years into the house, you're not going to have prepayment penalty.
All right, sounds good. And so another one I get that comes up a lot, this pre-qualified and pre-approved, what's the difference? And then how long does it take me to get pre-approved once I get finished with being pre-qualified?
Yeah, I love that question. There's really 3 versions right now. There's pre-qualified, pre-approved, and fully underwritten. Pre-qualified is Lloyd calls me and he says, "Hey, Rich, I'm making about 120,000 a year. I got about 100 grand in the bank. My credit's perfect. I'm looking for a $400,000 house. I want to put 20% down." Lloyd, you're pre-qualified. That sounds amazing. Now, what do I really know about Lloyd? Not a whole heck of a lot. I mean, I really don't. I know 4 things, but I haven't verified any of those things. Now, a pre-qualification, and I've still seen them in the market today, a pre-qualification is typically not based on any verification of anything. And so what you don't see in the market, or what you shouldn't see in the market, is a pre-qualification letter. If a lender gives you a letter that says you are pre-qualified, that is a lender that doesn't understand this market, because Lloyd can confirm. Lloyd, are you going to take a pre-qualification letter on your listing?
I can't do nothing with that.
Nope. That's garbage. So the next step is a pre-approval letter. Now, what is a pre-approval letter? That means the lender has taken the application. I go back to Lloyd and says, "Okay, you're making 120. How are you doing it?" "Well, I got a salaried position at Alphabet." "Okay, cool. So you're salaried at 120. Where's your $100,000? "It's in my money market account." "Fantastic. Your credit score is 780. Do you have any other debt?" "Nope." "Perfect. I'm going to look at Lloyd's credit." Then when I have all that information, he's been at Alphabet for a while, he's got 100 in the bank, we've reviewed his credit, we're going to run it through automated underwriting, and automated underwriting is going to tell me, hey, he's approved for what he's trying to accomplish. Now I can issue you a pre-approval letter. That letter has been the standard since the 90s. I know that because I've been here since that's been going on, right? About 7 years ago, Cross Country started doing something a little bit different, and now other lenders are doing it, but we were the first ones that I know that brought this to the marketplace, where once we pre-approved Lloyd, we said, "Hey, Lloyd, now we'd like to see your paycheck stubs. We'd like to see the W-2s. We'd like to get the last couple of bank statements. And we'd like to get everything in so we can give it to our underwriter so they can verify everything we did verbally. They could verify everything. And now I can come back to Lloyd and say, hey, Lloyd, you know what? I've actually approved your loan subject to title and appraisal, and I can close in 10 days or less." So that fully underwritten, we have a trademark term for it. We call it fast tracked. In the industry, it's known as being fully underwritten. We don't corner the market. There's other lenders that do it. Not a lot, but there are some other lenders out there that do it. If you're going to be in a tight market, and I'm going to predict that our spring market's going to be nice and lively because rates are going to be better. I think some of this stuff going on in the air, if you will have subsided. And I think, people are going to look at things a little bit more back to business. Things are going to be better. We're going to shift back into a seller's market. As a seller, I want that full approval. I want to know that Lloyd's been underwritten. I want to know that as long as I can give them clean title of my house appraised, we're going to close.
That was good. And I think that's some of the stuff I wanted to tackle, that application process, and some of the things that you as a lender that you're looking for from the buyer, some of the documents that I need to bring in, just in terms of bank statements, tax returns, and things of that sort. These are things that you need to see to help speed up the underwriting process. Is that correct?
Oh, absolutely. Yeah, we definitely need to. So typically we're going to need 30 days worth of paycheck stubs. If there's no self-employment or rental property, we would just need the last 2 W-2s, and we need the last 2 months of bank statements. Photo ID, we're done. So if somebody's self-employed or they have rental property, Now we're going to get into the last 2 years of tax returns. One or, if they've happened to have been divorced recently and that has some financial impact, they're either paying child support, receiving child support, we're definitely going to need a divorce decree. But that's about the end of it.
Okay, sounds good. Then last one, we get ready to start wrapping it up. I've closed, been in my house for a while, and interest rates are continuing to fall, as we described earlier. I think things to drop down maybe 5.5 in the next year or two. That would be nice, but it dropped down to 5.5, and I've been paying on this mortgage. Would it be a good idea for me to refinance?
Yeah, so I mean, we look at it at a point of how much are you going to be saving. And so everybody's got an idea in their head how much they want to save to make that whole thing worth their while. So if Lloyd, if you're sitting on a $900,000 mortgage and rates move a half a point, you'd be shocked how much money you're going to save because it's a $900,000 mortgage. If you're sitting on a $90,000 mortgage and rates move a half, there's nothing really to talk about because I might save you $22 a month. And my cost to do the $90,000 mortgage or the $900,000 mortgage is almost the same. So what we're going to be focusing on, rate's important, but what's important is how much money I'm going to save you every month.
And that's the most,
yeah, that's the most important thing. And I want to add one thing. So a couple stats that you and your listeners should know about, and some stuff. If you watch this before you go into Thanksgiving, you want some of these cool figures, right? Right now around the country, we have $1.2 trillion of credit card debt. $1.2 trillion of credit card debt. The average tappable equity, which means loanable equity in the United States, is $198,000. The average loan to value, and this is in the United States, is about 44%, meaning people are sitting on a lot of equity. Now, here's the really scary part. 59% of America has less than $10,000 in liquid reserves. Liquid reserves. So right now, a refinance might not just be about the interest rate. It might be about eliminating credit card debt, which is still in the 20% range, getting a little bit of money so you do have liquid emergency fund reserves, and then readjusting that payment. So the one thing about loanable equity, people are thrilled to have a house that doesn't have a mortgage on it. And don't get me wrong, that's the American dream. I got my free and clear house, right? But that equity is not doing anything for you. It's not working for you. And it's not there if you have an emergency. If you lose your job and you have a free and clear house, it is difficult to get a loan because you're not working anymore. So, the recommendation that I'll make for folks is that at minimum, have some sort of line of credit on that house so that you do have access to that equity if you do lose your job. You do have access to that equity if Lloyd comes to you and says, hey, I got this great investment opportunity. You could buy this 2-flat at a great deal. Be able to access and tap some of that equity to make investments down the road. It's really, really important. And in the refinance context of the question, if you're thinking about refinance and you're only thinking about saving money in the rate, what about your credit card debt? What about having a little bit of extra money in the bank? There's a lot of other things to look at with somebody that knows what they're doing. So,
got it. So we're talking about a HELOC or a home equity line of credit, correct?
Correct.
And being able to have access to that money if needed, and it doesn't necessarily mean you have to tap it, but it's there.
Right. It's there. Yep. Yeah. I mean, I've had a line for like $1.50 on my house for years that I haven't touched. I'll pay the extra $50 a year or whatever the lender wants. I don't care. I just want it in case I need, in case Lloyd calls me and says, hey man, I got this great opportunity. Why would I want to scramble for money? Okay, cool. I can write a check. Let's go.
Absolutely. Yeah. All right. Well, appreciate it, Rich. So really the home buying process and working with a lender is not as complicated as it may appear to be. Is that correct?
Yeah, it's definitely not as complicated. Don't be afraid to talk to the lender as far as that's concerned. The lenders are there to help you work you through anything that you need, whether it's getting your credit right, making sure you have your documentation, or explaining to you how your income is having an impact on your ability to qualify. Get with a lender first. That's really, really important and to get the process started. One thing I want to make sure we add is, and Lloyd, you may know this, I'm going to test you, put you on the spot. What do you think the average net worth of a homeowner is versus a renter?
I would think the homeowner would have a higher net worth, and I think not only with just equity, but I think over time with paying down your principal and paying down your mortgage that you are building up. So I would think the homeowner would probably be in a better position.
Always, always, always. And so you guys can Google it, go to AI. You're going to get an answer that's very consistent with the following number. The average homeowner has 40 times the net worth of an average renter. 40 times. You see, I've no matter how many times I look this up, it's either 38 to 43. It just depends on who's running the survey. It's 40. So if you're renting and listening to this, you got to get with a lender. You got to start being on the path to building wealth. We've already talked that 44% of America's wealth is in their equity. Stop renting. Start building wealth. Get with Lloyd. Get with me. And learn how to build wealth, maybe not just through home ownership, but maybe rental properties as well.
Absolutely. One more before I let you go, Rich.
Sure.
President Trump put out the idea of a 50-year mortgage.
Yeah.
Just wanted to get your take on that. Is it realistic?
Yeah. It's a pretty polarizing subject. So you talk to people and they either hate it or they love it. And let's take the politics out of it, because maybe that's the reasons people either hate it or love it. But, I'm just a numbers guy. Like, it all just boils down to numbers. I put this example in a calculator and I said, look, what if I borrowed $400,000 over 30 years at 6.5%? And then I took that same $400,000 loan and I put it in for 50 years. Now, one thing I know to be true, if I'm going to be giving you a 50-year mortgage, it's going to be more expensive than a 30-year mortgage. Just like a 30-year mortgage is more expensive than a 15. How much more expensive? I don't know. So let's just assume it's only a quarter of a point difference. So I took, instead of 6.5, I took 6.75. The difference in the payment between that $400,000 was $198 a month. So now, my opinion, to commit for another 20 years to save $198 a month, to me personally, it's not worth it. That's just my opinion. Now, there's some other people out there from another camp will be like, well, they could take that $200 and they can invest it in the stock market. They could take that $200 and they could send it in and prepay it. Sure, they could do a lot of things, but people have to be disciplined to do that at the end of the day. I don't think it's a good idea. However, like anything else, the market's going to tell us whether or not it's practical. If they come out with it and people jump all over it, I guess it's a thing.
Absolutely. That was kind of my sentiment with it too. I really didn't see it as being feasible or workable idea in the long run. I think like now, even with a 30-year mortgage, usually like the first 10 years, first 12 years, you're paying nothing but interest before you even start tackling your principal. And so I could imagine with a 50-year, how long it's going to take you to just knock off interest payments. That's going to be quite some time.
It's going to be forever.
Yeah. You're 20 years old and you buying a house. It's going to take you 50 years to pay off. You turn 70 by the time you're ready to pay the thing off. And now, as we mentioned earlier, that today's average homeowner, the age of them is 40 years old. So imagine starting at that point with a 50-year mortgage and you're 40 years old. It is like essentially you never get to the point where you pay your home off.
Yeah, no, I agree with you. Now, they mentioned there was kind of an underlying thing, which is interesting to me, but like anything else, I'd like to see it in real world. is that mortgage could be portable, so that, and maybe this has a little bit more credibility in the sense that, hey, rates dipped down. I got this 50-year mortgage at 5.99, and now I'm going to go buy something else, and rates are at 8%. So rather than me have to deal with 8% on the whole thing, can I take part of this and move it along? Now, again, mechanically, I have no idea how that works, and I'm in the industry close to 40 years. That being said, that's a little bit intriguing. But at the end of the day, the $200 savings on $400,000, I don't see the point in it. So,
Absolutely. Richard, you've been great, man. Can you tell our audience the best way to get in contact with you over at Cross Country Mortgage?
absolutely. So we've got a team here. I do a lot of training and education. So I've got 3 loan officers that are on my team that are always available. One number to get us all, 847-603-2300. And that's the best way to reach us. There's also richkimballteam.com if you just wanted to go to the website, RICHKIMBALL team.com, or just try it at that number. And while our offices are based in Elk Grove Village, we lend all across the United States.
Absolutely. And Richard always having some good educational content, and he talks with other vendors out there in the industry, and we get together from time to time. He hosts a lot of online events, which are phenomenal. We talk with a lot of people in the industry, just dealing with all types of things, including not only mortgage lenders, but appraisers and things of that sort. So this is a person that you want to keep up with in keeping your Rolodex.
Yeah.
That's the word that we can use today. I know it's kind of obsolete.
Does everybody know what a Rolodex is? I always feel bad.
I'm not sure. Richard, you've been great, man. We're glad to have you on, man. Hopefully we can get together again sometime in the future, man. Good conversation. I think these are some of the things that buyers be wanting to know. These are a lot of the questions that I get asked a lot as an agent. And a lot of times I think buyers sit on the sidelines because they be afraid to take the leap in underwriting and appraisals and inspections. All this stuff sounds scary. It's intimidating.
Right.
Even with just approaching and finding an agent. So a lot of these things can be challenging for people that are even interested, even if they not financially at the point, but just even to get started with the idea of eventually owning a home. And I think we tackled a lot of that today, man. So thanks for the conversation, man. Greatly appreciate it. And hopefully we can get together sometime in the future on some other topics and things like that, man. But thanks for coming on board, man.
Yeah, I look forward to it, Lloyd. This has been great. You're a great agent as far as that's concerned, providing this information and making it available. Again, kind of, I guess the important part is lowering the barriers. These barriers aren't there. A lot of these barriers, in my opinion, are self-imposed. Pick up the phone, reach out to somebody you know, reach out to Lloyd, reach out to me, start the process, see where you're at. It's not going to hurt. So, it's not going to hurt. And then, maybe we could talk about some other things in the future, Lloyd, about building wealth through investment properties. So
one of my favorites.
I'd love to tackle that with you next time, because I highly believe in it. And there's a lot of different things I see going on, specifically in our marketplace here in Chicago, that there's just a lot of potential here. So I'm excited about it.
A lot of potential here versus some other areas in the United States. A lot of potential in the Midwest.
Yeah. Absolutely.
And I think investors all over America see that. And that's why a lot of them gravitate toward the Midwest. No matter what they say about us, a lot of opportunities are here. So.
Yeah, I've got investors internationally investing here in Chicago. So we're doing some foreign national investing here in Chicago. We've got people from around the country that come here and invest in Chicago. It's regardless of whatever, whatever color brush you want to paint on the city, there are still people investing here, and it's still a solid real estate market. We're still gaining value here. So, again, I'm excited to be part of it.
I agree. Totally agree. All right. Well, everyone, thanks so much for tuning in. It's been Lloyd for Real Estate. Have any comments or questions, leave it in the comment section. And I'll put Rich's information in there so you can get in contact with him. We work together as a team. And if you're ready to make that leap, it's nothing to be afraid of. We're here to assist you and help you out. We got the tools and the resources that you need to make that leap, to make that step. And it just starts with a conversation. You start talking with someone that knows and that can assist you and give you the things that you need. So have that conversation with us. Here's your agent. And of course, we have Richard Kimball there, Cross Country Mortgage, and getting the job done and getting the things that we need done with the whole process. So thanks so much for tuning in. I want you to come back. Make sure you leave some comments, hit the subscribe button and that like button for me.
There you go.
Enjoy today's program, okay? So Richard, thanks so much, man. We'll be in touch.
Thanks, Lloyd. Appreciate the time. Take care, guys.
Okay.